Selling picking up its pace here in the final hour of trading. All three of the major averages ending the day in the red. You can see it on your screen with the Dow closing off just around 881 points. S&P off nearly 3%. The Nasdaq closing down just about 3.5%. That hot inflation print that we got this morning, record low consumer sentiment weighing on the markets. And that's just mentioned the jump that we're seeing in yields. The 10-year getting a bit of a bounce today. Sector action, consumer discretionary, technology, financials, all off just over 3%. We're seeing that rotation out of the cyclical. So joining us now for more on this, let's bring in Hal Reynolds. He's Los Angeles Capital Chief Investment Officer, along with Keith Lerner, Truist Co-Chief Investment Officer. Keith, let's start with you. What do you think of the print we got today and the selling action that we saw in the markets?
Well, first, Shauna, great to be with you. I wish we had more green on the board for ending the week. I think what happened today is that, there was a lot of hope that we would have a CPI number that would show some type of peak inflation, and we didn't get that. And, one of the reasons back in early April we downgraded equities to neutral after being very bullish is that we were concerned about, a Fed policy mistake, but also that they may break an ankle or two, trying to bring this to a soft landing. So I think, it is one number. It was an important number for the market, but it also reminds me now like how the monthly employment was the main number. Sometimes you have a bit of a knee-jerk reactions. People reassess over the weekend, come back as well. So we'll have to see, but by itself, it was a negative print.
Hal, what's the argument against a 75-point hike next week?
Well, many people are making that argument today. I prefer to see the Fed stay on course. I think it would be less disruptive to the market. And there's only so much they can do. But I know there's a big call for it today. I mean, the number was notable for two reasons. Both its level. It's the third time in the last year we've had a 1% read on inflation. That doesn't happen very often. It happened in the 1940s during a period of great growth, and of course in the 1970s. So it's sort of a rare event. And of course, much higher than the number a month ago. And also for its breadth, every category went up. So there's no doubt it's a serious number. But no, I think the argument is to stay the course. I think the likelihood of continued rate hikes into the fall, obviously that's gone up a bit. I think the other thing we have to really, we can't discount is the fact that the ECB this week announced that they're going to end their quantitative easing this summer. And let's be honest, we've all come quite accustomed to the quantitative easing over the last decade. It's really propelled equity valuations. And we're going to see a return to circumstances where the market is controlling the long end of the curve. And we saw it today with a parallel shift up. And that's bad for equity valuations.
Keith, what are your clients telling you in terms of how they're thinking about positioning their portfolios in this sort of environment?
Well, I will say it's more from our group. We've been basically advising a couple of things here over the last several months, really since February. We've been saying, after being very positive, let's bring in bets, upgrade portfolio quality, and also as far as sector positioning, we've been more defensive and also focused on more of the commodity-linked sectors. So as an example, I mean, we're all in the red today, but consumer staples is an overweight. That's you saw it today when there's concerns about the economy. That sector's outperforming. You're seeing healthcare outperform. And then even like a day like today, where there's some concerns about economic weakness, you're seeing the energy sector also outperform along with materials. So, we think that makes sense. We've also added some, high quality dividend type positions also. So the main theme is, whatever risk you would take in the last 2 years, we have a different market environment, and you want to be somewhat more defensive. One potential offset in a day where most of the news is negative. At least when we're down 19%, people are concerned about recession. Right now, if you look at the average recession drawdown, that's about 29%, or the median's 24%. So you're effectively pricing in somewhere between a 65 to 80% recession already, based at least on the historical averages of the market. Of course, you can overshoot, but that's, I think, noteworthy to think about it on a day where it's all in the red.
Hey, Hal, going back to what you said before, just in terms of the Fed, maybe they shouldn't be more aggressive at this point. The flip side of that argument is that we could see inflation. It could take much longer in order to rein that in. What do you say to that?
Well, it took them 10 years in the 1970s following Arthur Bird's actions in the early 70s. So it is going to take time. This is not a quick process. But we also don't want to disrupt the capital markets. And so I think, moving steadily in terms of 50 basis points, which is the messaging they've been giving the market, is the right course of action. And they're going to be data driven. and they can continue to do that into the fall. So I don't know. I just don't see that making a big difference, quite frankly. I think we saw what happened in the past. You know, I'm thinking back in the early 2000s when rates were increased by 4.5%, and it caused some problems, some real disruptions in the markets by increasing the short end of the curve so fast. So I like the path they're on. I don't think this is going to be an easy process. It's going to extend well into 2023. Inflation's not going to go away quickly for all the reasons that we all know. Wage inflation is here. COVID's not going away. We've got a siege in Ukraine, which is not going to go away quickly. It's going to take time.
Keith, with inflation and rising fastest since 1981, groceries since 1979, some are making the comparisons to our economy versus the late 70s, early 80s. How different are they, big picture?
Well, there's a lot of differences between now and then. I mean, the first thing, as far as I think about energy prices, back then we were much more a bigger consumer. We didn't have this big production. I mean, right now, as oil prices go up, it certainly hurts the consumer, but at least there's some profits coming back to our companies. So I think that's one thing. We don't have unions like we've had back in the 70s as well. And don't forget, it wasn't just 1 year of inflation, as mentioned by the other guests. We had 10 years as well. So I think that comparison maybe is a little bit overdone, but either way, I do think, the Fed's position is more challenging, probably the most challenging positions we've seen since the 70s. So I will, say that side of things, but also, again, demographics are much different then as well. And the geopolitical situation is different today also.
That's absolutely right. The biggest difference are the long-term deflationary pressures, which we did not have in the 1970s. So that's another reason. I mean, the idea that the Fed can get this just right is just, not possible. I mean, they're either going to overshoot or undershoot. But we have these massive deflationary pressures. We all remember them in 2019. It wasn't that long ago. And those conditions have not changed. So that couldn't be more different from the 1970s.
And so then, as we're seeing these comparisons then, in terms of what we can expect in some sort of recovery based on what we've seen in past recessions, what's the best way people should be positioning themselves? How?
We think the positioning, it really hasn't changed. It hasn't changed for our institutional clients, being long energy, being short consumer and consumer discretionary. Obviously, real wages are on the decline. Fiscal stimulus of maybe $1 trillion left is going to run off by year end. And so I think you can't help but be long energy and short discretionary at this point. I think the most important thing, because you can find good stocks across all sectors, is very high earnings quality with a focus on current earnings rather than longer term growth. Sentiment is still very much in that direction, and we expect that to continue through much of this year. I will say one thing: the valuations on growth stocks have come way down, as we all know. And our dividend discount models actually like some of the mega cap growth stocks, which it's been a long time since we've said that. And so in terms of, should inflation be longer than many expect, I think there is pricing power with some of these companies. Obviously, they'll be under wage pressure, but I think some of the growth companies, after interest rates normalize a bit, and that's months away, I think they'll be able to withstand some level of inflation once we're in the sort of back where we have real interest rates back in normal territory, where it's not such a headwind for valuations. So I don't think you can totally ignore growth. But right now, we're long energy and short consumer cyclicals.
All right, we'll have to leave it there. Hal Reynolds, Keith Lerner, appreciate you both and enjoy the weekend.